Market timing is the attempt to switch a significant portion of your assets between different times of investments in order to maximize profits. If this is your investment strategy, good luck, because you're going to need it. Lots of academics have shown that it's pretty much impossible to time the market. Nevertheless, active traders and get-rich-quick schemes continually claim that they've seen it in practice. Mathematics and game theory can help us determine if market timing is a good strategy. Too many investment decisions are made as a result of emotional considerations, and usually those emotions are greed, fear, and pride. Emotions can dim the vision of even seasoned investors, fooling them into thinking that their personal experience represents the set of all possible outcomes. Let's illustrate the problem by looking at a simple game. Consider the following game. You start with $1,000 and you play for 10 turns, and each turn you can invest your money in investment A or investment B. We'll call them heads and tails. And there's only two possible outcomes. Either investment A makes 30% and investment B breaks even, or otherwise investment B makes 30% and investment A breaks even. If you invest half of your money in investment A, heads, and half of your money in investment B, tails, you're guaranteed to earn 15% each turn. After 10 turns, your $1,000 will have appreciated to $4,046, and I'm going to call this the 50-50 asset allocation model. Now imagine that you decide to take a chance and each turn pick the investment that will earn 30%. I'll call this the lottery method. Since you can't lose money and your average return is still 15%, you'd think that on average you wouldn't do much worse than the 50-50 asset allocation. You couldn't be more wrong. Assuming that your chance is just a coin toss and you don't have the foreknowledge of which investment is going to do well, the odds are that you will do worse, much worse. Let's just take a look at the first two turns. With the 50-50 asset allocation model, your $1,000 grows to $1,150 and then to $1,322.50. The 15% gain on the first turn is compounded with another 15% gain on the second turn for a total compounded return of over 32%. If, on the other hand, you try to guess the best category, there are only 4 possibilities, and 3 of them are worse than the 50-50 asset allocation model. If you're wrong twice, you'll end up with your original $1,000. If you're right and then wrong, or wrong and then right, you'll earn 30%, and you'll end up with $1,300, falling $22.50 below the asset allocation model. Only if you're right each of the 2 times will you beat the returns of asset allocation. Your $1,000 from the first correct guess will appreciate to $1,300, and then on the second guess to $1,690. Only in that case would your 30% compounding return beat the average of the 50-50 asset allocation model. For those of you who are desperately trying to remember your high school math, this is a case where the mean average return is higher than the median, middle, or typical return. On average, you earn the same, but typically you fall below the consistent asset allocation model's return. Now imagine expanding this difference between mean and median, or average and middle, for 10 turns. In our 50-50 asset allocation model, with consistent 15% returns, your $1,000 grows to $4,046. If instead you use the lottery method, you will do better than the 50-50 asset allocation model less than 38% of the time. While your average return with the lottery method is still $4,046, it is buoyed up by the extremely rare case when you guess right 10 times in a row and you end up with $13,000. That pulls the average way up, and it means that the mean is much, much lower. If you're that rare individual that can guess right 10 times in a row, you will likely consider yourself brilliant and mistakenly believe that market timing works. You may even start an investment newsletter called The Lucky Penny and try to teach others your selection method. But this does not work. You have to pick the winning investment consistently in order for the lottery method to do better than the asset allocation. Our game did not even include the very real possibility of losing money. If the parameters of the game are changed to include the possibility of losing money, the 50-50 asset allocation does even better. Imagine, for example, a case where one of them triples in value and the other goes bankrupt. All it takes is one time picking the bankrupt company and you lose all of your earnings from that point forward. Losses are harder to recover from. In fact, losses hurt you more than wins help you. If you lose 50% of your capital one turn, you must gain more than 100% just to make up for it. In the real world, 50-50 asset allocation isn't the same thing as a risk-free investment, but it does offer a smoother ride than trying to pick this month's winning category. Math can explain a lot, but a few gray hairs help too. For more information, visit our website.